Thanks for tuning in to Talking Point Unfiltered. The idea of this podcast series is to try and get into the minds of our guests and understand how do they think about the current situation, be it business, be it markets, and what are the ramifications over the medium term and not necessarily what will happen tomorrow. Our guest today is Samit Vartak of SageOne. Samit, great having you. Thanks for taking the time out.
Absolutely my pleasure. So I think this is the first podcast I'm doing, so I'm looking forward to it.
Yeah, likewise, Samit. I mean, it's been the first time that we are talking on such a format as well, so really looking forward. So, Samit, there is no better time to talk about the market sentiment than when the market is at its worst, right? Because it probably gives you the best opportunities as well.
Yeah.
How do you see this current market environment? Because the unanimous calls that I get range from how it is prudent to not be invested in India currently. Yeah. If you want to be invested, then look at only the large caps. Don't look at the mid caps and the small caps, and keep a certain percentage of your portfolio in cash. There is almost nobody saying that start hunting actively in the mid cap and the small cap space, or that take an oversized bet out there in that bucket. How do you think about the situation?
Yeah, I mean, it's always good to have too many worries around you. You know, that's where you find value, right? So I think after a long time, at least you're finding exciting opportunities. It's not the universe which has become cheap, but surely, you know, if you're a stock picker, you don't need the universe to be cheap. At least there are so many companies in this kind of a market, you know, which are trading at like 15, 20 times kind of a multiple, you know, which were not available. I mean, what happens is that in this kind of a market, which is more driven by liquidity, when it comes down, again, it's because of the liquidity, right? That some people are forced to exit, you know, some just take allocation decisions at these kind of times. And it's an extremely consensus call these days that you allocate to large caps if you want to be in India and get out of mid and small cap kind of space. So when liquidity comes out, good, bad, doesn't matter. Everything falls. It's just a matter of liquidity. And there's so much money which had gone into this space that when things come out, in this kind of times, when there are so many, you know, alarming calls, who is going to be buying at this point? So there are very few buyers, a lot of sellers. Some are not getting out because they probably don't have liquidity to get out, right? So I think these are the times when you get this opportunity. And so I look at it as a cyclical, you know, it's like almost like an annual sale. Or sometimes there is one big sale which happens every, 3 years or, 2.5, 4 years. That's a very, very common timeline when there's a big sale which
is
happens.
That sale, you think?
I think so. This is definitely, see, last correction we had started in December 21 and it continued sort of towards, 22, probably half of the year. And then 3 years down the line, again, September 24 is when we had the peak in the market. So we're already there, 5-6 months. And generally, I've seen that the average duration of correction is that 6 to 9 months. Right? And the faster it corrects, the shorter is the duration.
Right.
So this time, I think the speed was pretty slow, but then last 1 month, the speed has just accelerated. Right, so there has been a sharp correction which has happened, and again, I think we need to remind ourselves that you will never get such a big sale unless there are warning signs around you. So I feel happy if there are too many people warning against it. That means that the weak hands can't withstand such warnings. Only the strong hands will withstand these kind of bombardment of warnings, not just from Indian investors, but also what's happening geopolitically. So I don't know what will happen in the next 3 months or 4 months, but I'm pretty sure if you are a good stock picker from a 3-year perspective, there is exciting opportunities, and it will be shocking to me if you can't make money over a 3 to 4 year period, reasonably above average kind of returns from the kind of valuations which are available in some of the select good quality companies. Right? And again, I think, I put up one analysis on Twitter which is comparing large cap, mid caps, and small caps, right? And I'm comparing more of large cap and small caps, where I divided the universe into 3 buckets. One is PSU companies, right? Then the private banks, because PSU companies and private banks trade at very different multiples, right? And then you have the rest of the universe, right? Large caps, when they say, large caps are trading at 19 times forward or, 21, 22 times kind of backward looking, is mainly because of the mix of the large caps. 1/3 of the profits in large caps come in from the PSU basket, which trades at 8, 10 times kind of a multiple, right? And then when you look at the private banks, which make up for about 17% more, so 50% total, again, they also trade at that 15, 17 kind of multiple. And then you have rest of the bucket, which is trading today at 40 plus multiple.
Interesting.
These are median valuations of, so then you compare that with the small caps, right? There is very little PSU as well as private bank contribution from these. The both put together probably will be 15%, right? So then you look at the mix, right? And then you have the 85% bucket, which is trading at 30, 32 times kind of a multiple compared to 40 plus in the large cap. That's the real comparison. You can't just compare a mix of bucket, which has all quality, but if the low quality is high in a certain bucket, overall you will feel that the valuations are low, but that's not really. I mean, how many portfolios have 33% allocation to PSUs?
So effectively you're saying that if you don't want to buy PSUs and if you don't want to buy private sector banks, then the large caps is probably more expensive than the median small cap.
Absolutely. Just look at all the companies.
Just
remove those 2 buckets, which are always cheap. You can't look at them from a P multiple, because for a 10 times P multiple in a PSU can be also expensive.
Right.
When they trade on an average 5 to 6 times multiple.
Now there's another question that I want to ask you. You're not an economist, so I'm not going to ask you if you think the economic conditions necessarily are different than what happened in the previous corrections, but you speak to your portfolio companies, you speak to, I'm guessing, your investors who are also running private companies, etc. Is the business confidence on the ground materially different than what had happened in the last correction? What I'm trying to get at is that after every correction, there has been a bounce because maybe the economic activity may have been strong, what have you. Is this time different?
I mean, see, people do talk about, there has been private capex which has been slow, and, there is not much confidence at the private level to put up that kind of a capex. But again, there is a big differentiation. Right? You see a macro level capex at the private level when large industries, like whether it's steel, crude, cement, they go for large capex. They haven't gone for large capex. Right? They have been pretty slow. But if you look at really good quality small cap companies, I don't know a single company, which is reasonably good quality with high growth, which is not going through a massive capex. Most of the time, I mean, the companies in which we have invested, almost all of them over the next 3 years or 4 years, or in the past couple of years, they have doubled their capacity. And there are a lot of, at a macro level, when you add these smaller companies up, it doesn't really contribute towards much of growth at a macro level. But when you look at sort of median growth for a lot of good quality mid and small cap side, you will see a huge growth in their gross blocks, which is very different. So that shows at a broader level in terms of number of promoters, who are positive, they are much more. If couple of promoters at the top level become really positive, then, which is a very different, which is minuscule percentage of promoters who are not putting up capex, mainly because probably they're not confident about, China competition or the massive, realist. I mean, if you look at cement, it's more of consolidation, right? Steel, they've already done capex, and there is so much dumping happening from China. In that environment, why would you?
Do capex.
You can't do capex. Crude, anyways, is a downtrending, commodity, and we don't know how this EV and the new renewable energy will transform and what kind of. So I don't think too much of capex is going into that, and they make up a huge portion of capex. So it doesn't contribute towards the GDP, but when you look at the number of companies, there are a massive number of companies who are going for capex.
They are. You reckon that
absolutely.
Broader in the spectrum.
There is no loss of confidence or any of that pessimistic view that they are going through. They are going through capex and they are delivering on numbers.
Okay, great. Okay, Samit, so we've established, at least in the first opening statements, that the economic conditions are not necessarily dramatically different or whatever impactful. And you believe that per se, even at the broader end of the spectrum, there is a good sale, the 3-year sale that is on right now. The question is, do you believe that you need to change your style? You are bottom up, you look for 20-25% growth over 3-4 years into every business that you do, and you largely bottom up investor. The sectoral view comes later on.
Yeah.
Do you need to change your style for the next 2-3 years, or you don't feel the need? You're confident that that style will pay off dividends?
Yeah, I mean, see, as a small cap investor, you have to take a longer term view, right? So someone coming into the market anyways needs to have much longer term view. There are many periods in history, in the past, where markets have not delivered returns for sometimes 4 years, 5 years, 8 years, right? And hence you need to have a much longer term, 5, 7, 8 years kind of view. And it's even more important in the small cap space because they tend to be very volatile, mainly from a liquidity perspective. When money flows out, to get out of those stocks, the impact on prices is way higher than what you can get out from the large cap stocks, and that's where they turn out to be riskier. So if you end up coming at the peak of the market and then they go down by 30-35%, to recover sometimes it can take much longer time. So you need to definitely have a much longer term horizon. Given that we have longer term horizon, I mean, you can't, because you can't time these kind of things, right? I need to think longer term. Now, again, you can't just base it on assumptions that, okay, this is the strategy that I need to go for, right? If you look at historical sort of, 10 baggers, sometimes 10 baggers are easy from the bottom of the cycle. If you picked up many companies, say in March 2009, you would have a lot of multi-baggers. Or if you picked it during COVID times, you'll have a lot of multi-baggers. But that's not the real way of analyzing, because those times are going to be 1% of your total duration, right? You don't get those opportunities. And you need to look at what kind of companies really deliver multi-baggers from the peak of the cycle. So I looked at, say, 2008 peak of the cycle, which is about 16 years, before us. What kind of companies delivered multi-bagger returns? 10x plus. Not in 10 years, which is what we target, but still in 15, 16 years, let's look at the companies which have delivered 10x kind of returns, right? So the most common factors, which are present in these companies, one is high sales growth. So I looked at the top 500 companies or a little more, and then divided them into 10x companies and the non-10x companies.
Okay.
Right? The 10x companies, the sales growth was higher. So the average sales growth was 15%. For the non-10x companies, the average growth was 10%. Right? Total sales growth was about 11%. So last 16 years sales growth is that. Right? So that's sort of the longer term growth rate of India. Right? The second most important factor was the starting ROE for the 10 baggers was about 25%. For the in 2008, remember the ROEs were very high.
Yes.
Across the board.
Yes,
So hence, these numbers are much higher. It was 25% for the 10 baggers.
10x,
And the rest was about 22%. Right? But the sustainable ROE today, the ROE for the 10 bagger has gone down to 19%. For the rest, they have collapsed by almost 30-40%.
Okay.
Right? So sustainable ROE, not just the top line growth, but sustainable ROE is one of the most important factor which contributed towards the 10 bagger. The third biggest factor was, of course, starting valuation was lower for these, not by too much, but at least 15-20% lower than what it was for the non-10 baggers. One more thing was the starting valuation. And these are the top, maybe 600-700 companies of India at that time. The starting valuation, average value or market cap of the 10 bagger was 3,400 something. And then the starting valuation for the non-10 bagger was 10,000 crores. Right?
The market cap.
Market cap. Meaning that the starting market cap itself was much lower. So these are the long-term factors, is that high sales growth, high ROE, sustainable ROE, and low valuation plus low market cap. Those are the companies who become 10 baggers, right? So that's what we look for, because if you are looking for 20-25% kind of a returns, they need to grow their bottom line by 20-25%.
True.
Those kind of parameters you will not find in large caps, because the top line growth for India is just 10-11% across the universe, and you're looking for almost double of that in terms of profit growth. And large cap makes up for India's GDP, majority of it, right? So which is, if the nominal GDP is growing at 10-11%, how do you find companies which are growing at 20-25%, right? So, and one more thing, the percentage of small cap companies becoming multi-bagger were double that of percentage of large cap becoming multi-bagger. So again, the hit rate was also higher, right? So if you are a good stock picker, and out of the universe of 500-600 small caps, if you can find 20-25 stocks which are superior to the average small caps, your success rate can be much higher than that.
Got it.
Right? So that's, that's where you don't really need to go through, change in strategy at every point in time. If you just focus on these parameters, then you're able to find. Imagine like the smallest large cap today is 1 lakh crore.
Yeah.
Right? If that needs to go up 10x in 10 years, that will be 10 lakh crore, right? That company will be in the top 10 or top 5 companies
Most
of India.
certainly.
What is the probability of that?
Yeah.
The smallest large cap cannot, become a 10 bagger.
10x.
It's mathematically impossible.
Yeah, almost
unless it's
impossible.
a completely outlier. So you need to find small caps which probably can become large caps. That's the only way to generate 20% plus returns. If you are not targeting that, focus on the large caps and get those 13-14% kind of return and be happy with it. Why take this additional risk, right? But if you are targeting 20%, then and if you are targeting that from the large cap, that's not possible.
Now, for a lot of people who may ask listeners and viewers that there should be actionable points in a conversation, I think the last answer gone by is truly the most actionable point. You don't need anything else. You get some of the key points, screen for yourself, do a little bit of research, and you will get the answers yourself. You actually won't need to watch the rest of the show also if you want. But I think, Samit, thank you so much. That was very well explained. Now, sure. I want to get to the mental aspect of it before I also nail it down to whether you find a confluence of all of these factors in the markets currently and what are those pockets maybe. But just one mental aspect that I want to get out here. You would be owning some small caps which would have seen a drawdown in this last 2-3 months, right? Some maybe 20%, some maybe 30, some maybe 50, what have you, right?
Yeah.
How do you decide where is it that you get out of?
Yeah.
And how do you decide, let me stay put? Because when it falls 30, 40, 50%, you are scared obviously about whether the story is gone wrong or is it just a valuation correction or everything is going down.
Yeah.
So how do you decide?
Yeah, so I think one of the big mental reset that one needs to do at this point in time is detach yourself from the existing portfolio. Think as if I am restarting, building a portfolio. I have new money, I need to build up a portfolio now. And see what kind of decisions will you take then, right? Unfortunately, what happens is that because of the baggage of, you having taken maybe wrong decisions, or just because of market, fall, things have corrected, you get clouded by a lot of those confusing facts, right? So once you remove that, build your completely new portfolio and then see, is it the same as what you have now? If there is a big difference, just change that. Just make that transition, because after all, your returns going forward will be based on today's valuation, based on today's optimal portfolio. And you need to build the optimal portfolio now without the baggage of having your old portfolio.
But it's an easier said than done thing. Are you able to do it?
I mean, it's just that you need, sometimes fund managers do have restrictions of getting out. Sometimes you just can't get out, right? Because by getting out, you probably will have 10% more fall or 15% more fall in the stock, right? So that becomes a hurdle. But for most of the investors, that's not a hurdle at all, right? So it's much easier for, a retail investor to do this adjustment, right? But at any point in time, even as a fund manager, I need to think, my portfolio is what it is, right? There will be some companies which maybe were highly valued. I may not be comfortable. I really love the businesses, but I don't like the valuation. A lot of those companies actually have come back to a very comfortable valuation. So you may have cash or may not have cash. The cash decisions would be very different. You may go for attractive, but I think you need to think about the same thing even here, that you think that whatever you have in your portfolio is an opportunity cost for you, right? You can easily replace that with something that you like, So if something else which is outside of your portfolio is much more attractive, you replace it. This is a time to swap. First of all, if you're in loss, this is a time where you can book losses, save paying taxes, and at the same time get something which is really attractive. So if you're aware of this fact, at least you will consider these factors for decision making, and it would help, because most investors would have lost value in their portfolio. They may not have cash, right? And it's easier for people who were lucky enough to keep cash. But don't bog yourself down with that. Whatever is in your hand, make the best optimal portfolio out of it, and then you'll be shocked. This can continue for sometimes 8 months, 9 months, sometimes a year, 2 years. But when things rebound, you will make up for not only the lost, portfolio value, but even make up really good returns in a matter of 4 or 5 months. It has happened multiple times. I mean, during 2009 fall, small caps had fallen by 70%. And in the next 14 months, the markets were up, the small cap was up 3.5x. That means they recovered entire fall. I mean, such a massive fall. This time it's, the fall is like 1/3 of that.
Yeah, exactly.
Right, 1/3. So it doesn't take much time to recover. But more importantly, make sure that the companies you have are the ones which will recover, because there will be many companies, in your portfolio, which may be a lot of story stocks, which would be much more cyclical, where there was a story, and many of the time in the long run do not do well. But, like I had made a presentation of how cyclical companies, in post-COVID, in the next 4 years, on an average, have gone up 10x. Whereas good quality companies have gone up less than 2x during those 4 years. There is a huge gap. Now, if you expect that these cyclical companies will continue to, if they have fallen by 50%, they'll quickly recover, that's like living in a fool's paradise.
So you believe that change will happen now? That
change will happen. But make sure that the portfolio that you have now is made out of companies which are longer term structural stories, where valuation has become really attractive. Forget about the fall in your existing stocks. Some of them will never recover. The breadth of this rise was so large that many of those stocks, I would say, sometimes 70-80% of the stocks will never see the recent highs in many years to come. But if you are just looking for 15-20 stocks, make sure that whatever stocks you have in your portfolio, have that high probability that they will, in 5 years, they will be much higher than the peak that you saw in the recent past.
And the simplest yardstick is possibility of higher sales growth, right? Because that was one of the key things.
Possibly higher sales growth, as well as possibility of sustainable ROE.
Both.
Because cyclical companies will not have sustainable ROEs. And they will have, generally cyclical ROE.
So you would have played cyclical companies from 21 to 24 if you had played, but you are also out of them. You are now going for the sustainable ROE businesses.
Yeah, I mean, see, one-off you can take a tactical opportunity, but majority of your portfolio, generally should not be. It's a high risk, high reward kind of a game. What we look for is high risk adjusted returns. That's more important.
Got it. So where do you find these pockets now, Samit? And by cyclicals, correct me if I'm wrong, but you are therefore effectively ruling out commodity plays or what else gets ruled out? Let's first eliminate that, according to you.
Yeah, see, highly cyclical companies. For example, what I mean by cyclical companies is let's take for an example railways companies. I had put up some analysis, a year back, on these some of the PSU companies, railways companies, how they had gone up, and their valuation multiples had multiplied 5x, 10x. Valuation multiples, not stocks. Valuation multiples, right? So these are the companies where what they sell, their replacement cycle is really long. Sometimes 25, 30 years, right? So you will have great growth for 3 years, 4 years, because, government is aggressively going for Capex. Right? So then you will have a huge order book which build up. But who knows, government can completely swap. They will completely reverse their decision of spending on a railway kind of a play and focus on something else, like suddenly. And then suddenly you will see that the order book has vanished, or it just staying flat, or going down slowly. And then no one wants to pay any valuation to these companies.
But so you are, sorry, just to interrupt here, but in a lot of these companies, the order books are still high. You believe the fortunes ahead will not be a factor of order book execution, but order continuation of order wins.
Exactly. There also has to be growth in order book, right?
Growth in order book also.
What P multiple, see, a lot of these highly cyclical companies generally trade at single digit multiples in the long run. PSUs also trade at single digit multiple because of that uncertainty. Generally they only have one customer. Railways also many times have one customer, and then the product replacement cycle is very long. That makes it more riskier. Plus they have huge fixed cost. So if you, during a bull market, go for too much of an expansion, raise too much of QIP money, when the things slow down, at that time your utilization goes down, fixed costs remain, and your margin just collapse. At that time, people go back, with low margin and low multiple. So the double whammy is huge, right? If your multiples from single digits had gone to as high as 40 times or 50 times, right? Add that to at the highest order book or the highest margins, that's one of the most riskiest things that you invest in. Because there is a risk to the valuation multiple as well as to the P multiple and as well as the growth. So that's what one needs to be careful. Are your companies, were they the ones where the valuation multiple went up too much? I'm pretty sure they will revert back towards the mean. Are their valuation like really away from their long-term mean? Are their margins towards the higher end? Are those based on really, huge order books, but is their product replacement cycle really, really long?
Got it.
If it's short, doesn't matter. Then you can, those are much more resilient businesses. And whether your cost structure and expansion was too high, and are you ready for the slowdown? If the slowdown comes in and you're sitting on a huge cost structure, it becomes pretty risky.
Does the same hold true for defense? The reason I ask is, for example, shipbuilding. We were talking to Garden Reach shipbuilders.
Yeah.
But that management, so the book-to-bill ratio must be maybe 5x or 6x.
Sure.
But while their order book is 24,000 crores, I'm using that as an example, by the way.
Sure.
The management said that they expect that their order backlog or order book by the end of FY26 could be 40,000 crores from 25. And they believe that orders worth 1,80,000 crores would come in over the next 2-3 years, of which they will get mid-teens to high-teens kind of orders. So they expect order inflow.
Okay.
Their valuations have come off because all defense stocks have come down.
Yeah.
And their execution table looks solid. So does defense look similar like railways, or is that slightly different, you reckon?
No.
I'm asking this because a lot of people are invested in defense names.
No. It could be very different. See, again, I would go back to the stock picking. It should be bottoms up. In an rising tide, all the companies in any sector goes up. Number of companies in those sector also go up, right? Unfortunately, 10 years down, if you look at the 10-year, long-term perspective, there will be few winners. There is no question about it.
That's true.
Question is, are you in those? If you're invested in the entire basket, I'm pretty sure that basket is not going to work. Not going to deliver. Right?
But so if the tide goes down, Samit, then will a good company also go down, or can a good company shine in a bad sector as well?
In the short run, it will also go down.
Okay.
In the short run, there is no like what happens in the upside, there is very little discrimination because it goes up because of the liquidity. In the short run, liquidity is what will take everything down.
Got it.
And that's where you get the opportunity to pick the right stocks. You look at examples of longer term companies, right? So for example, say APL Apollo. Steel cycle has gone nowhere. But in the last 10 years, look at their profit, profit delivery. Look at their, debt levels, what has happened. It's independent of the entire sector doing that well. Towards the end, and everyone gets funding and everyone starts doing well. But if you look at the next 10 years, 1 or 2 of those companies will be the winners.
Got it.
There won't be 10 players who would be the winners. So accordingly, I mean, you look at, in agrochemical companies like PI Industries, in consumer finance companies like Bajaj Finance or Chola, there will be only 1 or 2 winners. The rest will be below average, returns. And that's where you need to make sure whatever you are in are those winners. Think only from that longer term perspective, because most of the companies who went through upside where the promoters were taking advantage of frothy times, they went for multiple QIPs. They really don't have a real genuine long-term plan. They are making plans because now they are getting free money almost, and then they are deploying that money for expansion. But every expansion done at below ROE of what the investors return on investment requirement is destroying value, not growing value.
Right.
Any investment that goes which is above your return on investment, that's the only which adds market value, otherwise destroying market value. But during bad times, until that delivery really happens, there is a big gap of 2-3 years, because they're going through Capex and people get excited and they think that it's going to add as much gross block, their market cap also is going to go up that much. And unfortunately it doesn't happen. It happens for only 1 or 2 companies. And it happens across many sectors. So there will be multiple winners in this. There will be multiple winners in defense. There will be, in the renewable energy. There will be across a lot of cyclical companies too. But only bottoms up will work.
Only bottoms up. You're constructive on energy transition, or has it run its course?
Yeah, I mean, see, definitely India's requirement of power. There is no question about it, right? Now, I think there are certain players where regulations is the big advantage that they have, right? Because of the advantages, maybe duty structure that we have against, say, China. But now with Trump coming in, how this plays out, very few players would have insight into, how this will play out. So one regulatory change can sometimes destroy business models. If it doesn't change, I think, there are great opportunities. But then there could be one event risk, which can. Now, question is whether you want to ride through that event risk. If you want to ride, how much percentage of your portfolio do you want to ride through that kind of an event risk? Is all, these are all risk parameters in your bottoms up sort of stock picking. So your allocation, your conviction gets tested.
Are you riding it through an individual name? I mean, I don't want the name, but I'm just asking.
I mean, we are riding power because we think that, power will need to go through huge growth in India if India wants to succeed in terms of whatever GDP target they have. We are power deficit, so we are playing it through power finance or these electrical cables. So niche players which are more domestic oriented, right? So there are a lot of other cyclical ways of playing it which could be high beta, but we are not going for that.
So the pick and shall strategy, you effectively going for.
Yeah,
okay.
More domestic in nature.
Got it. Just one follow-up there though, Samit, is that, for example, the power financiers, I mean, there are a handful of them, right? There are 2 or 3, if you will. The recent trends, because there's a reversion that has happened, maybe it's the market which has brought everything down, but they kind of seem like they've virtually gone nowhere now, point to point, from now, at least back until 18-24 months, right?
Sure.
So you reckon that time will come, and how do you develop the patience therefore to wait for that time to come?
Right. So one is there is price, and one is there is fundamental performance. One is to look at what has happened over the last 18 months or 24 months. Right? There has been significant improvement. Just 2.5 years back, a lot of these guys were sitting on net NPAs of 4%. That net NPA has already gone down to 1%. And is expected to go down to 0. Right? So there is a significant improvement. There are many projects which they had taken provisions for, where they are writing back because the overall economics of the power sector has improved.
Right.
The collection from the state discoms, overall profitability into the system has taken a significant improvement. A lot of the losses they had taken were from private players, and now that book has almost gone down to near zero or like 4 to 5%, right? So if you look at the fundamentals, there is a significant improvement. And then, of course, I mean, it also depends on their growth, but their ROE still today is at 20%. Right? They're expecting growth between 15 to 20%. And if there are write backs, if they can improve the efficiency, they can still grow at 18, 20% plus kind of, growth. And where you are getting it at, 1.2, 1.3 times price to book, 1 year forward, which according to me is extremely cheap, and these are, these are long-term structural stories. I think the time to exit them when they go through a fundamental froth in the system. They go for extreme risk, and then their gross NPA start climbing, and then their book, is made out of really poor. So far, they have been pretty prudent. They're not just going for a wild kind of a growth. I feel it's a good proxy for India, right? And of course, that's one way to play, but you can also play it through electrical cables. Again, there are 3 or 4 players, but I believe that these are not just the cyclical, players. These are long-term structural players. Of course, in the financing, it's not, you can't take a 5-year, 10-year kind of a view, but you can take a view on, at least the path where they are improving in terms of ROE, in terms of, what their gross NPAs are, and what is the valuation at which you're getting.
And even the market has not recognized it now due to various factors. That recognition will come at some point of time.
Yeah, I mean, if they keep on delivering on the fundamental side, valuation just catch up. We just need, 4 or 5 months of really, the decent market where things are normalized, where the fear is, out. Right now, if the PSUs are getting penalized across the board, everything will get penalized. That's true. It will come down. You need to pick, which ones do you want to bet on.
Yeah. The other aspect is specialty chemicals. You rode that wave beautifully till 2020, 21. I know that personally, right? Because we've spoken about it so many times on the shows. Then it's been 3-4 years of an extreme lull, if you will. I was hoping, I had gone out and spoken about on the channel as well that everybody's talking about how Q3 could mark the reversal of fortunes fundamentally, what happened to stock. But somehow the Q3 numbers also left a bit to be desired, right?
Yeah.
And there's a lot of flux in the system. So what's your sense here on this very large bucket?
Yeah, at a total bucket level, I think there are 2 things which happened, which fundamentally I think has changed the attractiveness of this sector, which was one, unfortunately it collided with, it coincided at the same time, was post-COVID period, where pre-COVID, Chinese government wanted all the chemical players, the polluting companies, to move away from the urban to rural areas. Right, so there was that 2 to 3 years kind of a transition period where supply from China had gone down, which coincided with the post-COVID. Post-COVID, because of logistical restrictions and as well as short-term demand, going up on the pharma side, everyone wanted to stock up inventory, and that resulted in huge, demand at the same time when the supply wasn't there, and hence the margin just shot up. Right? Because the margin shot up, a lot of Indian players and across the globe, whoever had the supply made a lot of money. And as usual, they extrapolate, that this is going to sustain, and then they also put up their capacity. So that capacity slowly is coming on stream. Chinese players, when they shifted from urban to rural, they also went for 2x, 3x kind of capacity, because why not just, build
it up, if you're building afresh.
So now you are sitting on huge supply gap, supply demand gap.
Across chemistries?
Majority of the bulk chemicals but majority of chemicals. There are very, very, very few chemical players where China, doesn't have.
So you're not constructive?
I'm not that constructive. Again, it also depends on bottoms up. There would be 1, 2, 3, 4 winners, because there are too many players in but there would be those 10% who will be winners. Question is, if you can identify one of those, where, again, at an individual level, there is going to be a big difference between the demand supply gap. Right? So that's what we need to identify. Like, which are these companies who can compete against China, or if ideally who can export to China. Reverse, right? So there's not dumping, but China requires this. If you find such companies, or where China is not a player, or if it's, it's not going to be competitive, and then you are say exporting to the US market. But all those factors have to be considered, plus valuation and the sustainability of that growth. There may not be supply right now, but you also need to see whether there are players who are on the way to commercialize the supply, and all of that needs to be put together, and then accordingly you need to identify. I mean, it definitely, there are going to be huge winners out of this space again. I think so, but they may not be as many in numbers as what we saw in that 2011 to 2020 phase. They would be much less, just because of the demand supply gap.
Okay. My final question, Samit, and that is on the futuristic themes, because now we're starting to see them making their presence felt. New age companies or any few. I don't. By the way, I don't just mean tech players. I mean anything which is futuristic in nature and coming up. But use that as an example that we now have, or we will now have one tech company or a consumer tech company being a part of the index.
Yeah.
And a lot of people believe that what's happened in the West, wherein the consumer tech essentially became a large portion of the index as well, because the profit pools are growing. So from the futuristic themes, where is it that you are the most constructive? Here, you may have a view which is maybe 5-10 years out.
Yeah. So I'm not that good at picking these futuristic, themes, especially ones where they're not really making good profits, not making reasonable ROE, ROCs. As I said, I would like to pick companies which are high ROE already, where my evaluation whether they are sustainable, are they going to go through that 20% kind of growth, and I need little more certainty. Then I'm pretty sure out of these packs of new age there will be winners.
But that's not the pond that you're fishing in.
I don't have the ability to pick those right ones.
Okay, so then let me reverse the question, since I mentioned last question. So what would be the top 1 or 2 bets or top 2 or 3 bets in the portfolio? You may not choose to take names, but you could give an indication of what kind of businesses are there, what sectors do they belong in? Because I'm guessing now your portfolio is primed for the next 2-3 years, because you would have made changes, etc. So what are the top overweights?
Sure. So see, there are certain themes where I'm getting bullish again, just because of the valuation correction. There has been a huge time correction which these guys have gone through, and some of the themes which I like, one is secured finance, secured lending. So whether it's gold finance, and again there is one player who has significantly outperformed any other player in this, and where the gold prices have gone up by almost 40%, in rupee terms probably even more. So there is a huge sort of collateral that has developed where you still have the potential to grow. So secured lending, it could also be some of the home finance players which are going at 25%. You can see that their gross NPAs are still at 1%, and the valuations have halved. So there are really good opportunities in maybe the smaller ticket size, home finance companies, where they have pretty good risk evaluation, processes, right? Other area is, which I've been always bullish on, are things like fabrication pipes, where we do keep on changing the tactical allocation. It went through, at one point we had say allocation of 10% plus. When things slowed down, when the valuations went up, maybe we didn't think it was worth to completely exit it, but to reduce the allocation. So probably we took it to the lower end. But now if you see, there is a huge benefit to these players, mainly because of these patra players, or the scrap converters. The price difference between say HR coil, newly manufactured HR coil, and these converted from scrap is barely 1 or 2 rupees. Right? So there is a big market for these guys to capture from unorganized, because why would anyone want to buy? So a lot of these players may completely go out of business because they don't have too much of sustainable power. They could, if they can't really sell much and make profits, in a year or year and a half they go out of business and generally don't come back. So there is a big market for these guys to capture, even if at a total level there is not much growth. Again, I'm positive on the power finance, I'm positive on the luxury real estate, but these are again not sectoral bets that
these are all bottom up.
These are all completely bottoms up, and that's how the sectors sort of build up. You need to because the winners can come in from spaces which may not be at a sector level growing, but it could be that in a tough market, sometimes the weaker players just go out of business, and then the strong players still can grow at 20% plus, right? So that's what you want. That it's very difficult to bring in, because sometimes when the sector becomes too profitable, there are a lot of players who want to come into it. So you may get really good sort of feel from a demand side, but then supply can suddenly come up, and it just they destroy the economics of the entire sector. That's what is more important. I think the demand supply gap is most important. Demand is easier to predict. Supply is very difficult to predict, because you don't know where and how quick the supply will come from. And if you have more confidence about that gap remaining, even if the sector is slow growth, but if someone is taking away more market share, I think it's better to bet on that. Market share gain, I think, is one of the most resilient factor for sustaining ROE as well as resilient growth, because those players tend to grow during ups and down cycles. Whereas if you're just betting on sector play, you are completely riding the bull cycle of that sector. And if you get that bull cycle wrong,
then
and if there is too much capex which goes on, it can destroy your returns. You may make money in the short run when things are just evolving, but when things stabilize, at that time you could go through big drawdowns.
Great. Samit Vartak, so good talking to you. Thank you so much for appearing on Talking Point Unfiltered. Really appreciate your time today.
Thank you so much, Niraj.
Yeah. And viewers, thanks for tuning in.